It's 1983. Ronald Reagan is president. The S&P 500 is around 160. Every breath you take is dominating the radio. John Travolta is staying alive, and Warren Buffett has just written his 1983 letter to Berkshire Hathaway shareholders. This year, Berkshire bought Nebraska Furniture Mart. You can tell that this isn't just any other acquisition for Warren Buffett. The woman behind Nebraska Furniture Mart is a lady called Rose Blumkin, or Mrs. B for short. Warren's enthusiasm and admiration for her almost leaps off the page. Take a look at some of the things he writes about her, her family, and her business. Today, in 1983, Nebraska Furniture Mart's doing $100 million a year in revenue. Amazingly, it's doing this all from one store. One store. Not 300 stores, not 30 stores, not even 3 stores. No, it's doing this all from one store. Berkshire's bought 90% of the business, with the other 10% staying with Rose Blumkin and her family. Let's think back to last year. If you remember, Warren said he no longer thought return on equity was the best way to measure Berkshire's performance. Remember, he said it's becoming less relevant because Berkshire's investing in these companies where it partially owns the companies, and because of accounting rules, those earnings are not fully included in Berkshire's income statement. So he's now using the growth in Berkshire's book value. Okay, some of us might be thinking, what is book value? Book value tells you the cumulative amount that's put into a business. That's both through the money that its owners put in and the earnings that the business retains. Let's think of an analogy. Let's say you're a proud parent. You've got 2 kids, Jack and Jill. They've both just finished identical history degrees at the same university. So you as the parent have paid the same amount for each degree. Okay, so in this case, the book value of both degrees would be the same. Book value tells you what you've put in, but the intrinsic value, that is the present value of the cash generated by the degrees, that can be hugely different for both kids. In the same sort of way, companies can have similar book values, but hugely different intrinsic values. Book value tells you what has been put in. Intrinsic value estimates what you can take out. This is one of the best letters to read in terms of learning about investing. You've got Warren Buffett talking about how his views on investing have changed over the past 35 years. Back in the day, he favored businesses with a lot of tangible assets. By tangible assets, we're talking about things like property, manufacturing plants and equipment, and physical goods or inventories. But since then, he's come to favor businesses that do not have a lot of this stuff. Okay, let's actually have a look at how some of Berkshire's businesses have done this year. One of them is a company called the Buffalo Evening News. Let's first set the stage the right way. Remember, this is 1983, people. Newspapers are one of the dominant ways that people get their information. Warren Buffett looks at something called a newspaper's penetration ratio to get a feel for how well accepted that newspaper is by the public. A newspaper's penetration ratio is the percentage of households in the community that buy that newspaper every day. Well, Berkshire Hathaway's newspaper, the Buffalo News, actually had the highest weekday penetration ratio among the 100 biggest newspapers in the United States. This is pretty cool. Although most people don't see him as one, in 1983, Warren's starting to become a little media mogul of note. The public may be more aware of media tycoons like Ted Turner, Summer Redstone, and Michael Eisner, but Warren Buffett is starting to get some media stripes of his own already at this point. See's Candy is a business that Warren Buffett loves both as a consumer and as the actual owner of the business. This letter shows some pretty cool information on See's Candy. Warren Buffett and Charlie Munger bought the company in 1972 for $25 million. Here's some basic info on how See's did that year. It did $31 million in revenue, $2 million in net profits, and again, it cost $25 million to buy the whole company. That $25 million purchase price turned out to be a steal. just a steal and a great example of the beauty of pricing power. In 1983, this year, 11 years after the company was bought, it did $134 million in revenue and $14 million in earnings. So in 11 years, sales have risen 4 times and earnings are up nearly 7 times. That works out to sales growing at 14% a year over the 11 years and earnings growing 19% a year over that time. What's really cool about this 14% annual growth in sales is that only 3.5% came from selling more candy. The other 10.5% came from price increases. Now, it's not like Berkshire doesn't want to grow the volume of candy sold each year by the more than 3.5% it's done. If it could grow those volumes more, of course it would like to do so. But despite this, it's been able to increase revenues by 14% a year because they've generally increased the price of the candy by 10.5%. Now that's pricing power. And pricing power is really the best protection an investor or business has against inflation. This is one of many great passages written by Warren in his letters on investing. It's often thought that asset-heavy businesses are the best way to protect oneself against inflation. Yeah, to some degree, this is true. Valuable real estate can do well during inflation because, firstly, if it is valuable property, its income and valuation should keep up with inflation. But secondly, most real estate is bought with quite a bit of debt, and so if that debt was borrowed on a fixed rate basis, the value of that debt gets eroded by inflation as time goes on. But generally, asset-heavy businesses really suffer during inflation. They usually earn lower rates of return that barely give the company enough money to reinvest into the business just to keep up with the inflation. It's a really tough cycle. And remember, inflation increases the amount of investment that a business needs to put into working capital. That's things like inventories and receivables and fixed assets. That is, long-term assets like plant and machinery. Businesses with pricing power have what Warren explains to be economic goodwill. They're usually very asset light. This ability to earn high returns or unusually large profits can come from a few different characteristics of the business. Firstly, the business can have what Warren calls a consumer franchise. That is, a great reputation with consumers. It could also be a government franchise, so for example, TV stations in the 1970s and 80s, or it could even be patents on drugs. Okay, no, not those kind of drugs, these kind of drugs. Or it could also be a company with lower costs than competitors that allow it to sell products at the same prices but earn higher margins because of those lower costs. Whoa, okay, that was a lot. Let's go back to the See's Candy investment for a second. What's interesting about this is that over these last 11 years since Berkshire bought the business in 1972, it's grown way quicker, a lot quicker than the type of investments people sometimes associate value investing with. Growing earnings at 19% a year over 11 years, that's eye-catching. The cool thing about the investment is that it was basically bought at a PE of 12.5 times, or an earnings yield of 8%. Which is only slightly above the 10-year yield at the time, that is 10-year government bonds. They were around 6 or 7%. So by 1972 standards, it may have been a somewhat full-looking price, but as time has gone on, wow, it's been shown to be a bargain. A sweet, sweet bargain.